Thought we would do a quick take on the inflation print. That May's inflation print was, we think, the cycle high here. And thought it would be good for us to discuss how we think about inflation when we look at the numbers, what it means to us in terms of where inflation's heading, and how we use inflation in our framework, in our investment framework.
This is how we look at inflation because this is what we think matters for asset prices. The path of inflation, is it high or low? Is it rising or falling? And we always think in probabilities, right? So a lot of people can get caught up trying to call the absolute peak in inflation or the exact number of the year over year print 3 months out. That's nice, but that's less important compared to just the overall path and whether or not it's rising or falling. And so what does this framework suggest? Well, as we get into the June of this year and then out over the next 4 quarters into our forecast period, you see there is extremely high confidence we will be in a high and falling inflationary environment. As we get into December, there's a 93% chance that we will be in high and falling. So that's about as close to certainty as we can get. And that is what's important. That's important when we think about positioning portfolios and when do bonds start to look attractive.
Yeah, so just look back at the periods in 21 where it was almost a certainty that inflation was going to be high and rising. Yeah. So can you compare and contrast those probabilities and why they're so strong?
Yeah. The high and rising probability at the end of March of this year, we got to 96%. And you can see that data point on the regime shift chart at the bottom there, March 2022, it's off to the right. And the reason why that probability was so high is because it was substantially above the long-term average of 2.5. That was a 40-year high. Okay, so we're extremely confident that the March print was not below 2.5. Okay, it was high. And then also you can see how quickly it was rising. So it wasn't the fastest increase we'd ever seen. June 2021 was the fastest increase, the rising the quickest, but still rising very quickly. And all these things are happening coming off of depressed prices out of the pandemic, right? That's how you get inflation to rise that quickly and get that high. Eventually, once things start to normalize, whatever that looks like, it just gets harder and harder to keep inflation rising at this clip.
Mm-hmm. And so our forecast shows for June 2022, there's an 18% probability that it could go a little higher. So there is a small chance, but that as we move through the rest of 22 into 23, there is almost more certainty that we will be high and falling.
Yes. Yep.
So let's throw up the next chart and talk about inflation components, and in this most recent report, what we see under the surface here.
Yeah, and what everybody saw is the blue line, headline CPI year over year up 8.6%, new cycle high, 0.1% higher than the March print, which was 8.5. But as you start to look under the surface, we finally are starting to see the percentage of all the CPI components with inflation running above 5, finally starting to see that number come down. So the breadth of the inflation shock getting a little narrower. That's just it's just a seed that potentially we're approaching sort of a crest in inflation here. Fewer items in the basket are seeing 5% plus increases. That's a decent start.
Yeah. And let's throw up the heat map here and look at the components. And there are clearly some hot ones. And you can speak to some of these components and how they're trending.
Yeah, was careful on the last slide to say decent start because you see it's still very hot.
Yeah.
There's still a long way to go. And what's another thing that's important to look at is the difference between headline and core. So headline CPI was hot. Why? Because food prices were up over 10% year over year. I mean, that's heavily influenced by what's happening with Russia and Ukraine and how that's impacting global commodity markets. Energy prices up almost 35% year over year. So a new high there. And that, once again, being heavily impacted by what's going on in commodity markets in Russia and Ukraine. And so, the Fed can't do anything to solve those problems. All right. They cannot solve the Russia-Ukraine crisis. They cannot reconfigure global commodity markets. What they're going to do, and what they are doing, is start to slow demand for some of the core goods. And we are finally seeing some softening there. So you see core CPI peaked in March at 6.5. The May print was 6. And if you look at the goods components, we finally see some softening there. Things like apparel. If we look into the services segment, the alarming thing is shelter. Shelter at a new high, 5.5%. So that includes owner's equivalent rent, rent of primary residence.
Right.
That is something the Fed can control by making sure mortgage rates get really high and housing prices level out, because rents follow housing prices. And it appears as though they're in the early innings of it, but with mortgage rates being well above 5.5% now and sales activity slowing, it's likely that housing prices are going to level out here, and that shelter component should start to level out or even come down as well.
Yeah, so that's a great look at some of the specific prices, and the Fed can really do specific things like, for example, the mortgage rates, where they can slow housing prices rapidly by rapidly increasing rates. But for broader inflation, let's take a look at the next chart and look at base effects and the different paths potentially inflation could take from here.
Yep. Yeah. So what we have here, and to illustrate what we mean when we talk about base effects, we throw around base effects and peak base effects, and that's going to bring inflation down. So the way that we think it's easiest to think about this is, if from here, let's say for the next 12 months, CPI, headline CPI, increases month over month by the average rate we've seen since 1960. That's, over 2.5% year over year. So less than that on a month over month. If we just increase at that rate, you would get the green line. So in 12 months, the year over year inflation print would drop below 4 to about 3.8%. Because yes, prices are still increasing over the next 12 months, but they're increasing at a lower rate than this huge inflation shock we've seen over the past 18 to 24 months.
Mm-hmm.
So you're adding slower price gains onto the front of your year-over-year comparison. So that is somewhat near the base case, because we're seeing the Fed start to have an impact on some of these core numbers, and the economic growth is starting to slow, which leads into the red line. What if the Fed acknowledges that, hey, the only way we get inflation down to our target of 2% in any short period of time is to actually slow demand to the point where we bring upon a recession? And so that's what you see in the red line. What if inflation increases over the next 12 months by the average rate that we've seen since all recessions since the 80s? And that's the red line. So inflation would come down pretty quick. Nothing fights inflation like a recession. So that's not our base case, but it seems as though the Fed might be willing to bring on a recession in order to make sure they win the long-term war against inflation. Mm-hmm. And then the last line is the light blue line, and this further illustrates the base effects. Let's just say everything the Fed has done thus far and is going to do has absolutely no impact. And inflation continues to increase by the average rate it has increased since the pandemic, since June 2020. It still would fall. It still would flatten out and roll over. So that, once again, when you start to build the month over month numbers out, really stress test these numbers, that's where it goes back to what we spoke earlier. We're going to be in a high and falling inflationary environment. There's pretty high probability we're going to be in that environment. It's just how quickly are we falling, and how quickly do we get into that environment?
And does the quickness of the deceleration relate to the economic pain to suffer to get there?
Oh, for sure. If you want to get a negative month over month inflation print, which is the quickest way to bring down the year over year number, right? You just tack a negative month over month on the front end. that's pretty much, those types of numbers are pretty much reserved for a recession.
Right.
So, yeah.
So it'll be interesting to see how they talk about inflation in the July meeting when they get together. And if we get 75, 100, who knows?
Mm-hmm.
But that was a great primer, and we'll bring another recap after the June release of CPI.